Well, good evening, everyone. And I'm pleased to have the opportunity to present to you. I am Ian Hargreaves, the one of the two managers of the Invesco Asia Trust. I'm going to talk a lot about Asia in this presentation, and I just want to clarify at the start, I'm talking about Asia ex-Japan. So Japan is not part of the mandate of the trust. And what I'd like to do to start off with is to spend a few minutes just to explain the investment philosophy of Invesco Asia Trust for those of you who are not familiar with it. Um, our key focus is on investing in companies that are worth more than the market believes. And this puts valuation at the heart of our investment process. And you can see with this chart, um, it shows the relationship between a company's fair value through time and its share price. And as you can see, the share price is much more volatile than the underlying fair value of the company. And this happens because the fundamentals of all companies shift over time, sometimes for the positive, sometimes for the negative. But in our view, the market has a tendency to extrapolate these shifts into the future. And so you get these periods of overvaluation and undervaluation. And this is the source of opportunity as far as we're concerned. So our investment process is built around trying to identify and invest in companies that are trading at a significant discount to our estimate of fair value, and to sell them when they reach fair value. And so in order to do that, there are a few sort of key elements to the process. Number one, we often look in unloved areas of the market for new ideas. Once we've identified a potential candidate, we spend considerable effort getting to understand the business fundamentals and to try and understand why it is that the market price might be wrong. And this really requires us to employ long-term thinking. And also we consider downside risk as well as upside risk. And frankly, it often necessitates the courage to move against mainstream thinking. Next, I just wanted to perhaps illustrate the process with a recent investment that we made about a year ago in the trust. You can see here the share price chart overlaid with the investment trust's holding, which is the light blue line. So Mingyang is a manufacturer of wind turbines in China. It's the second biggest player, but it happens to be also the leader in offshore wind turbines, which is the fastest growing area of the market in China. And it's also a pioneer in floating wind turbines. And I think pertinent to China, it's also a private company. We got interested in Mingyang because we noticed that it was trading at about half the valuation of some of the European competitors like Vestas, despite having better growth and better profitability. And when we spent some time looking at it, we came to understand that the reason for this apparent undervaluation was that China has had a shifting subsidy regime, which leads to these periods of boom and bust in the orders and the earnings cycle of the companies involved. But when we looked at the medium term renewable electricity needs for China, for them to meet their goal in 2030 of seeing peak carbon emissions, it became pretty clear to us that the market was underestimating the long-term growth of this business. And we also felt that there was nothing in the price for a small but rapidly growing export business as well. And what we found over the last year or so is, as the subsidy regime has actually been phased out over 2021 and 2022, that the market has begun to also focus on the long term, and we've seen the stock re-rated. I suppose the best way to prove whether a process works well is the long-term performance, and this slide hopefully demonstrates that the process has delivered value over the long term. So over a 10-year period, the investment trust has delivered an annualized outperformance of around 3% after cost every year. Now, I'd like to move on and talk about our views on the region. And I actually talked at a AJ Bell webinar almost exactly a year ago. And I remember thinking at the time that it was a little tricky because actually I wasn't feeling terribly positive on the market at that point, given how well it had performed. And I think as we stand today, we're now, 1 year into quite a significant correction in Asian markets. And Asia has really been underperforming for almost a year. Other global markets really have only started their corrective phase much more recently, since the beginning of this year. So why is that? I think Asia, and particularly China, was first to recover from COVID. China had a good first round of COVID, if you like, and so you saw equities rebound much more quickly there than we saw in some other markets globally. And as often happens with these kind of equity rebounds, you get to a point where expectations in the market become too high, and those expectations for growth are hard to achieve. And I think one of the things that we found particularly was that Asia, the policy stimulus that we've seen has been a lot less aggressive than we've seen in the US or in Europe. And China in particular, from the beginning of 2020, started to actually tighten policy. And so we ended up with a much more mixed economic picture in Asia, and that just didn't meet the bullish expectations of the market as it was in the first quarter of last year. But just as we care a lot about the price we pay for individual stocks, I think the same is also true at the market level. And this chart is probably the most important one in the presentation if you're thinking about whether there's a good time now to invest in Asia. What it shows is historically, if the kind of 5-year returns that one would have made by investing in Asia at different levels of valuation historically. So you can see on the right-hand side of the chart here that where we were in February last year at over 2 times book for the region, that has actually been associated with negative returns on a 5-year compounded basis. So that was a point, a warning sign for the market. Where we are today, having come down to 1.6, and with market declines during March, actually we're closer to 1.5 now. That has historically been associated with increasingly attractive returns for long-term shareholders. So we would say that if we see any further derating from here, it's really quite an interesting entry point for Asian equities. This chart just shows the simple ratio of analysts' upgrades to downgrades of their earnings estimates, and we think of this as a contrarian signal. So what we've seen historically is that analyst optimism tends to crescendo at the same time as the stock market, and we saw that at the beginning of last year, and you can see that during the bottom of the pandemic in early 2020. The opposite was the case, and downgrades were very high, and analysts were very pessimistic. So, this to us is a further corroboration that that the market is starting to look more interesting, because analysts have certainly toned down their expectations for growth over the last year or so. And I think there's certainly a risk in the short term that this continues to come down. I think we're still in the process of figuring out the implications of the rising commodity prices that we've seen as a result of what's been going on in Ukraine. What will that mean for demand and for margins for companies? And then I think also we need to be cognizant of the fact that that COVID is starting to apparently take hold in China, and so that may also have some impact on earnings, at least in the short term. So in addition to looking more attractive in an absolute sense, we think that Asia is actually looks pretty interesting from a relative point of view, which of course is important if you're thinking of how to allocate your money on a sort of a global equity basis. So the chart here just shows that Asian equities are pretty much back down to their all-time low discount versus US equities over the last 15 years or so. And I think that's particularly interesting because when we look at some of the fundamentals, there seems to be a growing divergence between what we see in Asia and what we see in the developed world. And here I'm using inflation as an example. So, as we said, the post-COVID economic rebound has been surprisingly strong in the US and in Europe. And I think that's really a result of this extraordinary stimulus that we've seen. And the result of that, well, one of the results of that now is that we're seeing inflation start to take off, and that's apparent in consumer prices as we've got here, but it's also can be seen in wages and in housing, in house prices as well. And so there's a growing need to normalize policy, and that may well prove to be a headwind for valuations in developed equities. I think by contrast, in Asia, the dark blue line here, just as the economic recovery, as I've said, was a bit more patchy and modest, we've also seen a lot less pressure on inflation as a result. So you end up with this quite unusual situation, certainly in my career, where you're seeing developed market inflation running, at a minimum of double the rate of inflation in Asia. And when you look at what that means for interest rates, we end up with this strange situation where real interest rates in Asia are at record levels versus the US, this is reflects, on the one hand, in Asia, a relatively conservative monetary policy, with interest rates above the level of inflation, and whereas in the US, of course, interest rates are substantially below where inflation is. And I think this is important for two reasons. Firstly, whereas historically we might have worried about US tightening cycles, creating challenges for Asian economies, currencies, and equity markets, I think we should expect a much greater resilience this time around. I think secondly, Asia has much greater policy flexibility right now to respond to the adverse events, such as the potential commodity price shock that we're seeing coming out of the war in Ukraine at the moment. And I think this policy flexibility is particularly applicable to China. So while we're debating in the US and Europe, we're debating the timing and the extent of policy tightening. In the case of China, policies actually come full circle, and it's one of the few major economies globally where policymakers are actually looking to actively stabilize or accelerate growth. And you can see with this chart, it's the credit impulse, which just shows the level of new credit flowing into the economy monthly relative to GDP. And so you can see a very short spike in early 2020, but then a very quick and immediate decision to actually try and focus on financial deleveraging. And I think that's been great for the long-term health of the economy, but it's definitely contributed to relatively weak consumption in China, and that's affected the earnings growth of domestically oriented companies. Now, however, policy, when you listen to the rhetoric of the government and evidence in the numbers, policy is now clearly in easing mode. And as I was saying, there's in the short term definitely a risk that with the arrival of Omicron in China that leads to further short-term weakness in growth. But in my view, that would almost certainly lead to a more aggressive policy action on the part of the authorities. Looking at Asia more broadly, consumption still remains quite substantially below the pre-pandemic path. And so, when we look at this, we see ample scope for recovery in future years. As China's policy U-turn starts to have a positive impact, and I think also just generally Asia starts to move to a living with COVID approach like we've seen in the UK, and I think that will have the potential to release pent up consumption. I think one of the things that has been holding back the recovery has been the relatively lower vaccination rates in Asia, and you can see from this chart that those are finally catching up with the UK. So in the round, given Asia's low relative valuations, I think this recovery potential seems to be underpriced by the market. On top of this idea that absolute and relative valuations are looking attractive, I think that there's one other opportunity for us as fund managers in Asia at the moment, and that's this big divergence that we've seen in performance and valuation between the markets within in the region, and that gives us some opportunities to add some value in the trust. You can see from this chart that on the left-hand side, the larger countries like Taiwan and India have been the standout performers over the last year, and from the bottom of COVID as well, actually. Whereas towards the right-hand side, you can see that Korea and particularly China have dragged down equity returns for the region as a whole over the last year. And that is opening up some interesting valuation divergences. And here, it's a slightly complicated chart, but what it shows, the blue bars are for each country the average price to book valuation over the last 10 years, and then the dots represent the current level of valuation, and also the pink diamond is the valuation 12 months ago. And this is ranked from left to right by the most expensive compared to their history to the cheapest. And again, unsurprisingly, you can see that Taiwan and India are trading at big premiums to their historical valuation range. In the case of Taiwan, it reflects the positive impact that the pandemic has had on demand for technology goods. And this has given Taiwanese companies a good deal of pricing power because some of these products were in short supply. But we worry that in some cases, we may see some mean reversion of that demand and profitability as we move ahead. In the case of India, I think there's a growing optimism, which to some degree we share, that the pieces are falling in place, that India may finally start to achieve or fulfill its potential and achieve the higher growth after, frankly, several years of false dawns. And then at the other end of the spectrum, you have ASEAN countries where they've had a kind of faltering COVID response, which has held back growth. And then, it's China, in on the right-hand side here, which really stands out for having this wide gap between the two dots, and that just represents the big derating that we've seen in Chinese equities over the last year. And I think this is the result of a gradual accumulation of negativity over the year. It started, as I've said, with a decision to tighten policy quite early on in the recovery, particularly focusing on the property sector. And that's led to some credit problems amongst the property development sector. A well-known casualty has been Evergrande. But we've also seen a barrage of new regulation, which has affected the internet sector, which is a really important and large sector within the Chinese equity market. And then really just in the last few weeks, we've seen this sort of, I suppose, a crescendo of bearishness on China, leading to some fairly eye-popping share price moves in both directions. I think as of Tuesday, the whole of the MSCI China was trading at less than 9 times earnings, which is substantially below long-term averages. And I think there have been a number of things at work here. I think increasing worries about the impact of China's close relationship with Russia, given what's going on. I think there have this acceleration of COVID cases in China, which is concerning people. But I think probably the most important thing has been a growing sense, and this is tied up with this internet regulation, that the Chinese government is really willing to sacrifice private sector profits in pursuit of this idea of common prosperity. And that's really been undermining business confidence and also undermining stock market confidence as well. And I think what it needed was, something explicit from the government that demonstrated this wasn't the case, and we got that yesterday in the form of a statement by one of the, I think, probably the most senior economic policymaker in China, Liu He. I think what made it interesting was he specifically addressed all of the market's points of concern. He talked about a concrete and coordinated action plan to bolster the economy. He made it clear that this process of re-regulating the internet industry was close to the end, and that it was really important that companies should have a transparent framework, within which to operate. And I think that is a really clear sign that the government gets this idea that it's very dangerous to undermine, the all-important private sector in China. So in conclusion, I guess just very briefly on China is we think that valuations are now really attractive, and even after the rebound that we've seen just in the last couple of days, we're still at half the level that we were at valuation-wise from a year ago. And I guess to sum up, Asia has undergone a big derating, and absolute and relative valuations are looking more and more attractive, and I don't think reflect the fundamentals of the region. And I think particularly the fall in Chinese equities at the moment is providing a really interesting opportunity. And that's it for me.